My name is Ashley Landry, and this is my presentation for our investment strategy for Finance 695. As you know, I'm taping it on my laptop, so it's going to be a little difficult to see my PowerPoint presentation, but at the end I will videotape so you can see the whole thing and actually get a clear view of everything. So as you know, we had to come up with an investment strategy and test it to see if it had any correlation. So when I was trying to come up with a good investment strategy, I chose to look at the profitability ratios. And as you know, when we do our financial analysis, there are three main profitability ratios that you look at, and that's profit margin, ROE, and ROA. I chose to focus my strategy on profit margin. So why would an investor want to consider the profit margin ratio and consider a strategy with that? Well, there's a number of different reasons. And my first thought is when you're investing in a company, it's almost like you're buying a company or starting a company. So your main reason of buying or starting a company is going to be to generate profits. So that's my main reason why I want to focus on profitability ratios, because if I were to buy stocks, I want to have returns generated for me. So I want to make sure that a company can generate good returns. So I chose to look at profit margin. And basically, profit margin is net income divided by sales. And it's a good profitability ratio to look at because it shows the percentage of sales, and it also shows how a company is with their financial health. As you can see, this ratio must be large enough to cover the costs associated with running a company and also provide revenue and profit over that. And so this ratio describes that. It also shows a company's major inflows and outflows of money. And when you're considering investing in a stock and investing in a company, you want to know how they're generating their profits, and you want to know how they're moving their money and how their flow of money is happening. And since this kind of shows a great indicator of that, you know, are they good with net income? Are they good with sales? This is why this ratio is really good. The other reason why you may want to consider a strategy with profit margin is because profit margin affects ROE. As we know, ROE is profit margin times asset turnover times the equity multiplier. And we know that ROE is a measure of rate of return for stockholders. As an investor, you want to look at what exactly is driving the ROE figures, in which you'll notice profit margin can play a large role in calculating the ROE figures. When you break it on down to the DuPont analysis, you'll see that profit margin is actually tax burden times the interest burden times the operating margin. So once you break down the DuPont analysis and see what is exactly driving the ROE figures, you want to make sure that it's good amounts, and profit margin can be a large factor in that. So that's why you may want to consider looking at profitability ratios and looking at profit margin. So my strategy was a higher profit margin will yield higher returns. And basically what I did is I went on Bloomberg and also a little bit on Yahoo Finance and pulled the Dow 30 companies, and I pulled their 2012 profit margin figures and also their 2012 stock return figures. And I conducted a regression test to test my theory to see if higher profit margin will actually generate higher returns. So I'm not sure how much you can see, but this is a summary of my regression test that I performed in Excel. And basically we were looking to see, is the X variable of the p-value less than 0.05? If so, the sample is statistically significantly different. And as you can see, if you look at the X variable under the p-value, it's actually 0.710075992. So as you can see that there is not a correlation between higher profit margin and higher returns, since the p-value of the X value is greater than 0.05. And this shows that the sample is not statistically significantly different. Thank you.